Welcome to Chapter 6 of Essentials of Investments. This is an important chapter, maybe one of the more complex ones. Interesting. It's about diversification, how to diversify your portfolio to lower your risk. And we'll learn about that in this chapter. So, first of all, we're going to learn, remind you at least of a few terms you may be familiar with. First of all, there is risk that is common to the whole economy. That includes things like inflation changes, unemployment, GDP growth. Those type of factors impact all companies. And there are multiple terms that apply to that. Market risk, systematic risk, or non-diversifiable risk all mean the same things. And those are common risks that are common to all companies. And then the second type of risk are all known by these names: unique risk, firm specific, and so on. And this risk can be diversified, so it's called diversifiable risk. Systematic risk cannot be diversified because all companies have exposure to it, or to those risks. And therefore, that's called non-diversifiable risk. But the nice thing about unique risk is that we can eliminate it, virtually eliminate it, by diversifying across various companies. This chart does a good job of displaying that concept that market risk down here goes to this level. We're going to have at least this amount of risk. And then if we were to only invest in one company, our standard deviation on the Y here would be very high. And as we layer more companies, add more stocks to our portfolio, we'd begin to diversify that portfolio, and our unique risk would fall. And eventually, as we add more and more companies, we could virtually eliminate it and get it down to this level of just market risk. So we only have that exposure to market risk. And you may recall from an earlier class that our exposure, the exposure a company has to market risk or systematic risk, is known as beta. And I think we'll cover that in a coming chapter. When we add multiple securities to our portfolio, adding them willy-nilly, just randomly, is not the best approach because the portfolio risk depends on covariance. In other words, how related the track record of returns are between two assets. So our ideal is that, let's say we've got security A that has this type of a history of returns, higher returns here, lower returns here. If we found security, let's call this A right here. If we found another security that had more this sort of a track record in returns over various economic scenarios, whether we're in a boom period or a bust period, we'll label that B, then this would be they would have a very low covariance. They do not track the same. Then our return history would be more of a less volatile experience for us. So we're really looking for securities that have low covariance or low correlation coefficient. We'll talk about that more in a sec. But the first step that we would need to follow in order to understand our risk and return in the two security portfolio is our expected return of the portfolio, P for portfolio, would be the weighting or what percentage we have in security 1 multiplied by its return plus the weighting in the second security multiplied by its return. So we'll go through an example here. But before we do, you can enjoy unraveling these formulas here for covariance and correlation coefficient. Now, my hope is that you will not have to learn these formulas and replicate them. Possibly we'll do that with a spreadsheet, but I don't think there's enough value, the cost benefit to learn these formulas and to solve them is probably not very high, a return on your time investment. So we'll try to avoid that. But that's what the formulas are. So first of all, we start out with our capital market expectations. The capital market expectations are forecasts that large financial institutions make with a team of analysts and economists. T. Rowe Price has those available on the internet, as does BlackRock and others, Goldman Sachs, I believe. So they would forecast what they think the next 5-year, 10-year, various time horizons in the future, what they think the returns will be for various asset classes. For instance, small stocks, large stocks, international funds. Well, in this example, we're keeping it very basic, just a stock fund and a bond fund. We've developed what we think, or an analyst has, what the return will be here in this column. This is a stock fund return, and what the probability of each economic scenario is. And then we simply multiply the probability of a scenario times the forecasted return under, in this case, a severe recession, and that gives us a number, okay? And then we total these and this column to get what our expected return or mean return would be. And for the stock fund, it's 10%. For the bond fund, it's 5%. So this is step one. What is our expected returns for a stock fund and a bond fund? And that's how that is developed. I'll walk you through quickly again on how to calculate variance and standard deviation. On the stock fund, the last slide, we had a mean return for the stock fund of 10%. So the difference between, let's take the severe recession line here, the difference between a minus 37 and a positive 10 is a minus 47. So that is our deviation from our expected return. We're 47 points off of the minus 37 is 47 points from positive 10, right? We square the minus 47 and get 2209. And we do that for each of these economic scenarios here, for each line. Now we multiply the 2209 times the probability over here of 0.05, and we get 110.45. We do that for each line, sum them, and we get the total there is variance. You've calculated variance, and take the square root of variance, and you'd get the standard deviation. So we do that for both the stock fund and the bond fund. We want to calculate the performance of a portfolio in a stock and bond combination. And if we have 40% of our portfolio in stocks and 60% in bonds, and this is the way you would do it. Unfortunately, that blinked off my screen. But if you have 40% in stocks, you would multiply 0.4 times this number, and 0.6 on the bond funds would be, the 60% in bonds would be multiplied by minus 9. And you would sum those two, and you would get a negative 20.2 for the portfolio. So the portfolio here in a severe recession would, and our portfolio that we're examining is 40% stocks, 60% bonds. So again, 40% of this number plus 60% of this number, add that, and you would get a negative 20.2. So I've plugged that negative 20.2 number into this little worksheet, spreadsheet, and I showed you how to calculate the negative 20.2. You do that for each scenario of the economy here. And then you work this through exactly like I showed you a minute ago to calculate variance and standard deviation, and you get these numbers here. So you can see that the standard deviation is of a 40% stock fund plus a 60% bond fund to get the 100%, the standard deviation is 6.65, which is lower than the standard deviation of either the stock fund, right here, or the bond fund. So the bond fund had a standard deviation of 8.27. We found by adding 40% stocks to that, to bonds, we can lower our standard deviation, which means that lowers our volatility and we would have less big drops, or at least the drops would not be as deep. And of course, the peaks from month to month returns would not be as sharp either. So that is the magic of diversification.